The most dangerous threat to your financial future right now isn't sitting in Washington, D.C., and it certainly isn't a domestic tax policy. It is a mathematical inevitability unfolding 6,000 miles away that virtually no one is discussing. For the last 3 decades, the global financial system has relied on a specific glitch, a loop of infinite, free money that allowed Wall Street to leverage itself to the moon without consequence. That glitch didn't just get patched. It just exploded. We are witnessing the end of the greatest arbitrage trade in history. The tectonic plates of the global economy are shifting because the one anchor that held interest rates down, Japan, has just let go of the rope. If you think this is just foreign news that doesn't concern your 401k or your property value, you are making a catastrophic error. When the largest creditor in the world starts panicking, the debtor that's us gets the margin call. To understand why your portfolio is about to feel the shockwaves, we have to look at the epicenter, Japan. This is a nation that has been running the world's longest economic experiment, operating with a debt-to-GDP ratio of 250%. To put that into perspective, imagine earning $50,000 a year but owing the bank $125,000, with no intention of ever paying down the principal. For 30 years, they sustained this by keeping interest rates at zero. It was an artificial coma induced by the central bank. But the patient has woken up, and they are thrashing. The Bank of Japan has been forced to raise interest rates to levels not seen since the mid-90s. That might sound like a return to normalcy, but in a system built on free debt, normal is fatal. They have stopped buying bonds to suppress rates and have started selling. This pivot is the financial equivalent of a black hole opening up in the bond market. Yields on Japanese debt are skyrocketing to historical highs, signaling that the bond vigilantes have finally stormed the castle. This brings us to the political theater, which only accelerates the fire. We are seeing a push for massive fiscal spending in Japan precisely when the market can no longer absorb the debt. It is the definition of insanity, trying to cure a debt crisis with more debt. The bond market's reaction has been violent. Yields have moved with a volatility that statistical models say should only happen once every 100 million years. When boring bond traders start panicking, it means the foundation of the global financial architecture is cracking. Now, why does a yield spike in Tokyo matter to an investor in New York or London because of the carry trade? This is the mechanism that has artificially inflated U.S. asset prices for years. Here's how the free money glitch worked. Institutional investors would borrow yen in Japan for virtually zero cost. They would then take that free money, convert it to U.S. dollars, and buy U.S. treasuries paying 4 or 5%. It was risk-free profit. It was a license to print money. But the math has changed. With Japanese rates rising, the cost to borrow that yen has exploded. Simultaneously, the currency risk has returned. No sane investor is going to borrow expensive yen to buy U.S. debt for a tiny shrinking margin. The trade is dead. And now comes the unwind. All those investors who borrowed yen to buy American assets have to reverse the process. They must sell the U.S. assets to buy back the yen and pay off their loans. We are talking about Japan holding over $1 trillion in U.S. debt. That is more than the entire GDP of most nations. They are the single largest foreign holder of American IOUs. As this carry trade unwinds, that capital is flowing out of the U.S. and back to Japan. This creates a massive selling pressure on U.S. treasuries. When everyone sells bonds, yields spike. And when yields spike, everything else breaks. The contagion doesn't stop at government bonds. This is where the hedge funds enter the picture. They didn't just do the carry trade with their own money. They leveraged it. Estimates suggest there could be up to $20 trillion tied up in these leveraged trades. Hedge funds operate on thin margins. They treat the market like a casino where the house never wins. But now the house is calling in the chips. When these funds get hit with a margin call because the yen is rising, they don't just sell what they want to sell. They sell what they can sell. They sell the most liquid assets first. That means the S&P 500. That means the NASDAQ. That means your crypto holdings. We have seen previews of this before flash crashes where Bitcoin drops 20% and the NASDAQ sheds 10% in days. That is the sound of liquidity evaporating. This is the correlation breakdown. In a traditional portfolio, bonds are your airbag. When stocks crash, investors flee to bonds, driving bond prices up and offsetting the equity losses. That is the logic behind the classic 60-40 portfolio. But in a sovereign debt crisis, that logic fails. When the creditworthiness of the system itself is in question, stocks and bonds fall together. There's no airbag. You are driving at 100 miles an hour toward a brick wall, and the safety mechanisms have been disabled. Even the giants of the industry are sounding the alarm. We are seeing warnings that bonds have lost their special status as a hedge. It is now effectively 100% risk exposure. The smart money knows this. They are seeing that the US government is relying on foreign entities to keep its borrowing costs low, and those foreign entities are walking away from the table. The US Treasury is effectively hoping that foreign central banks will use calming words to stabilize the market. When your economic strategy relies on hope and polite speeches, you are in deep trouble. So, what happens to the average investor holding Apple, Microsoft, or a standard index fund? These companies are quality, yes, but their stock prices are floated on a sea of liquidity that is being drained. If hedge funds are forced to de-risk, they will dump high-flying tech stocks to cover their losses in the currency market. It is a chain reaction. Your portfolio is collateral damage in a war between central banks and the bond market. However, chaos is a ladder if you know how to climb it. The goal here is not to panic, but to reposition. We are entering a cycle where value and defense become the only games in town. The era of buying anything and watching it go up is over. We are looking at a rotation into assets that have intrinsic value and are detached from the banking system's leverage. Gold and silver are flashing signals here. Historically, when trust and sovereign debt erodes, capital flees to hard assets. If stocks and bonds are both falling, gold often decouples and acts as the true safe haven. It is not about getting rich quick, it is about wealth preservation while the fiat currencies battle it out. Beyond precious metals, we have to look at the stock sectors that survive inflation and yield spikes. We are talking about energy, oil majors, companies that pull essential resources out of the ground. We are looking at consumer staples, the companies that sell the things people buy regardless of the economy. Toothpaste, food, basic necessities. These are the defensive fortifications for your capital. Conversely, the danger zone is expanding. Regional banks and financials are directly in the line of fire. They hold massive amounts of debt that is losing value every day. Yields rise. High-debt companies, the so-called zombie corporations that can barely pay the interest on their loans, are going to be wiped out as refinancing becomes impossible. And discretionary retail? When people feel poor, they stop buying luxury handbags and expensive gadgets. Real estate is a double-edged sword in this environment. While the government might want to lower rates to save the economy, the market is forcing rates higher. Mortgage rates are tied to the bond market, not the Fed's wishes. If the 10-year Treasury yield spikes because Japan is selling, mortgage rates go up and housing affordability crashes further. The indicators to watch are specific and flashing red. Watch the US 10-year yield. If it breaks key resistance levels, it signals that the sell-off is accelerating. Watch the dollar-yen exchange rate. If the yen strengthens rapidly, it means the carry trade is unwinding faster than the system can handle. These are the dashboard lights that tell you the engine is overheating. The narrative that the government will simply fix it is losing credibility. We are seeing a situation where the sheer volume of debt issuance is overwhelming the demand. The US needs to sell trillions in debt, and its biggest customer just closed their wallet. This is a supply and demand imbalance of epic proportions. Ultimately, this is about preparation. The transfer of wealth during a liquidity crisis flows from the unprepared to the prepared. It flows from those holding paper promises to those holding real assets. The storm originating in Japan is not a temporary weather event. It is a climate shift for the global economy. The days of easy money are behind us. The days of active defensive risk management are here. Don't be the liquidity that the hedge funds use to exit their positions. Be the fortress that stands when the tide goes out.